afternoon and welcome to another Barometer webcast. I'm Pamela Hastings, Relationship Manager at Barometer Capital. And joining me today, as always, is David Burrows, our Chief Investment Strategist and President here at Barometer. During this webcast, we will provide you with a brief macro overview and, of course, be pleased to address your questions at the tail end of the call. So don't be shy. Please email me at phastings@barometercapital.ca or hit me up on the chat and the Zoom link. And with that, I turn the conversation over to David Burrows on what's I'm hoping a beautiful spring afternoon with summer just around the corner. Good afternoon, David.
Hey, Pamela, how are you?
I'm well, thank you so much.
So happy to have everybody with us today. And, it's been an interesting few weeks. So we have to just put one foot in front of the other. And this is where process becomes really important. Obviously, nobody likes to see asset values fall in their portfolios. We have always to battle the fear factor in those situations. We also have to manage on the up days a little bit of greed because nobody wants to miss out. But these are tricky markets, and I think that you have to be very methodical. And so we just want to start, as always, sort of with a high-level view as to where we think things are from a structural theme and market perspective, and then talk a little bit tactically about how to be positioned and maybe the things we want to still avoid as we go along here. So just to kick off, as always, we put up the chart of the long-term picture of the Dow back to 1900. And we know that the dark blue period, structural bull markets, are the most productive periods to be invested. Doesn't mean that there aren't sharp pullbacks along the way, but certainly it generally is sort of 3 to 4 steps forward for each one step back. And the step backs tend to be short and sharp. They are painful, but they're over relatively quickly. In structural bear markets, we tend to have these longer, more steady dripping declines that really will break the sentiment of investors. And generally by the end of a structural bear market, people really have a belief that the asset class is probably one they shouldn't be considering any longer, which is why so many people miss the first part of a good lift. And so we started the structural bull market in 2013 when we exceeded the highs from the late 1990s. And since then, we have been marching our way higher in some periods of time where people just could not believe things could continue to work the way that they had. When the corrections came in 2015, 16, 2018, and 2020, they were very painful and a little bit scary. But we have continued to work our way higher. So our base case is we're in a structural bull market for stocks. And when we put the more near-term pictures, sort of the 1980s and 90s, the bear market of 2000 through 13, and the more recent years up, we can see that bear markets in a structural bear market look very different than the pullbacks, and in some cases, technically bear markets, like in 2018 or 2020, they tend to be over quite quickly. What we've seen so far, and we can't always know exactly where things are going, is something that would be quite typical of a bull market correction. It's been short and sharp. It's been driven by a number of factors, not insignificantly by a new Fed cycle and conflict in Ukraine and Russia and COVID that we've been through. But again, very consistent with what we tend to see in structural bull markets. So we give the benefit of the doubt to continue to be a structural bull market. We'll talk a little bit about that as we go along. We also have had a view that we've gone through a structural bottoming in interest rates, and that much like the early 1950s, rates are likely to move higher, not straight higher, but in fits and starts. And we have to recognize that what works in a move higher in interest rates is really generally quite different than what works in a structurally falling rate environment. And so it's hard to get your head around that. I think a lot of investors struggle with that, and it's probably caused them to hold on to some of the tech holdings that they've had longer than they might have otherwise, given the fact that they've just built tremendous confidence in higher and higher multiples as rates went lower and lower. When we look at the 10-year yield, we know that in 1982, we're up here around 16%. We were consistently from the mid 80s on below falling long-term moving averages. And we know that just recently, for the first time since 1984 or 85, are back above moving averages. So we've had a very sharp move from roughly 40 basis points to through 3%. We're sitting now just below 3%. But as we talked about a couple of weeks ago, likely it is that now yields will have to do a little bit of work. It would be unlikely we see a significant overshoot of a downward sloping long-term moving average, but certainly that sharp move higher in yields puts some fear into equity investors, and certainly multiples have come down as a result of that. But we are very, very overbought on yields. If you look at the stochastics are more overbought than at any time since 1981. And we know what happened at that point. We had some lower yields. So this is something that is significant. We have been short fixed income over the last 18 months. We talked about the fact that we took our short positions off over the last 3 weeks. We have no further fixed income short positions. We think that largely the main part of this main move may be over. And if that's the case, we were to see yields moderate or just slow down a bit, maybe that might help some of the other risk assets, but we'll have to see. So we know that the long US Treasury TLT ETF has come off roughly just about 38% at the lows about 2 weeks ago. And we're sitting above those prices today, but that's been a significant and scary decline for a lot of fixed income investors. You know, this was the worst start to the year for fixed income really on record, and that certainly has had an impact. When we talk about commodity prices really, you know, continue to be very, very firm. We broke the downtrend we were in from 2008 through 2021. These are monthly bars, and you can see that prices in general just slowly have marched higher. This is an equally weighted basket of various commodities, energy, and materials, and it continues to be very, very constructive on a long-term basis. And when we talked about the fact that when you start to see relative outperformance in commodities versus equities, it doesn't tend to be something that is short-lived and likely could go on for a long time. And one of the things that we always want to see is when risk assets pull back in price, what is it that holds up relatively better than the rest? And certainly everything pulled back somewhat over the last number of weeks, but we can see that when we look at the RJI index and look at relative strength versus the S&P, it has just continued to march its way higher. And in fact, on Monday made a new relative high versus the S&P. So this, as far as a theme goes, really continues to look like it is in the early stages of a structural bull market. And that has implications for the companies that produce these commodities, some of the agricultural companies and some of the materials companies. Let's go back to the S&P for a moment. This is the spider. 2 weeks ago, we thought that if we broke these lows from February and April, that we might get a sort of a little whoosh down, which we did, of course, through the course of last week, having a little reversal on Thursday and Friday, and then following through somewhat today. So this chart was from a little earlier on in the day. It looks like the S&P closed up about 2%, rallying back up underneath these lows. Significant, but what I would note is that we have been seeing falling volume. So one of the things that we care about when you get a reversal is you want to see one big up day, and then over the next 5 days, you want to see a follow through day where the market's up more than 1.75%, which we got today, but you want to see rising volume. And I would say one thing that was lacking today was some volume and follow through. Prices were higher. There was a vacuum of sellers, and perhaps it was some short covering. And all of those things are positive, but we really haven't yet seen a big pickup in volume, a big bread thrust. So we'll have to see. 90% up day on Friday, strong day today. This is the NASDAQ, but again, somewhat lacking in volume. So the NASDAQ's been the weakling. down roughly 30% to the lows from the highs in late December. And that is significant. We have to keep in mind. We'll talk a little bit about that as we go along. So what we have to do as a firm and as investors is have process, because you can make a case subjectively for why the market's cheap and should get better. And you can also make a case for why it is that it could continue to weaken. So we just have a set of rules that we follow. And just as a reminder, we have three basic pieces to our process. If 80% of return comes from getting to the right asset class, in this case, we believe has been basic materials and energy, then within those asset classes, identify the key sectors. 80% of return comes from getting to the right neighborhood. 20% of return is finding specific securities within those neighborhoods to express the view. And in our view, we're trying to find securities that are good getting better. So we run three processes. Our top-down models look for expanding breadth across asset classes and sectors where the breadth of the advance is expanding. And then within those groups, we look for securities that meet our business tests where we're seeing improving fundamental characteristics. So improvements in the income statement, the balance sheet, specifically acceleration in change. And then we want to see price behaving the way that it should be given that fundamental view. So if the fundamentals appear to be improving and the technical picture is declining, there's a disconnect somewhere. That's not for us. We're looking for fundamentally sound, good getting better, and price that's good getting better as well in parts of the market that are showing expanding breadth. When I say expanding breadth, I mean when you get to late in a decline, very often, most things have been hurt. The strongest securities often will turn up first, often before market bottoms. And then as a market starts to improve, the percent of stocks participating or performing well should expand. And so a healthy market is where more and more securities are participating in a rally. That's when we want to be putting on positions. On the other hand, when you head into a correction, usually the leaders carry on at the beginning while the weaklings fall away. But if enough securities roll over one by one, the leaders will eventually get hit. And so that's the condition that we've gone through recently. We've had deterioration in breadth over the course of the last several months, starting with unprofitable tech and working its way through things like consumer discretionary, industrials, financials, communications. And eventually, the week before last, even energy and basic materials, which had been the strongest, got impacted and pulled back as well. So the question is, if we start through a bottoming process, what is it that turns up first? And that's what we spend our time watching. So just to walk through it. Last week on May the 10th, this is what our breadth models looked like. Percent of stocks in uptrends in Canada had been falling. Percent of stocks in the NYSE, which were in uptrends, had been falling. Percent of stocks in uptrends globally in equities had been falling. Those are our long-term indicators. We use point and figure charts to identify whether something's in higher highs and higher lows or lower lows and lower highs. The secondary set of tools we use are some short-term breadth models. One measures the percent of stocks trading above their 50-day moving average. And in Canada, that had been falling. Same in the US, same as from a world perspective. And when we look a closer look at the NYSE, percentage of stocks with positive leaky price momentum was falling. Percent of stocks making new highs versus new lows was falling. And percent of stocks trading above their 150-week moving average or 30-week moving average or 50-day moving average. All of these things caused us to sit on our hands. We use our stop losses to reduce our positions as things roll over, but we don't put new positions on. As of this week, some small improvements. First of all, the percent of stocks with positive weekly price momentum ticked higher as of today, reversing that recent weakness. Percent of stocks trading above the 150-day moving average should reverse up today. And yesterday, the percent of stocks trading above their 50-day moving average turned higher. So there's some green shoots. And then, of course, we've got to look below the level of the market itself. to say from a sector perspective, where are we seeing relative price performance? Where are we seeing improvement in breadth? When we look globally, you can see if you were to put all the countries globally on a distribution curve, the ones in pink are showing deterioration in breadth. So Asia Pacific, Latin America, the Middle East, all showing weakness. Okay, Europe, similar. The only two markets that recently reversed up a week ago, Hong Kong and China, which is interesting because they really led us on the way down. And we have seen some improvement in the verbiage coming out of the regulators in China as to the clampdown on technology and as to the easing cycle. So that's something to watch. In our macro portfolio this week, we put a very small China position on, and we'll see because breadth has started to expand. But you can see for the most part, globally, we are not seeing expansion as of yet. So let's go back to the leadership themes and see how they're hanging in, see whether they have held in better on the decline, and more importantly, what's happened over the last week as we started to see a little bit of improvement from a market perspective. So let's start with the strongest group in the market until recently, and that's energy. This is the XEG, TSX Capped Energy Index, pulled back to the 50-day moving average. But look, on the first sign of strength, right on back to new highs, and relative strength making new relative highs today versus the S&P. That's exactly what we want to see. Held on longer and popped back to the surface almost immediately on the first sign of strength from a market perspective. Now, if your major concern is that we have some kind of global recession, or we have a recession in the US, it's unlikely that we would see energy continue to make relative highs. But that's just one piece of a puzzle, but it's an important one for us. It's been our largest weight in the portfolios going back for many months. This continues to be leadership. When we look at the price of oil, moving from the companies to the commodity, it's a really important picture because we know going back to 2014, we were in a bear market in energy prices, culminating at the low point after COVID. But only recently, in the beginning of 2022, broke out of the range we started into in 2014. We pulled back to the moving averages over the last few weeks, but every time the market went lower, we made higher lows in energy. And here we are almost back to highs. So both the commodity and the energy producers continue to look good. Now we can look at refiners, we can look at service companies, we can look at producers, all of them behaving the same way, all of them continuing to show leadership. Let's step away from energy and look at broad commodities. This is agricultural commodities. On a short-term basis, this goes back to last summer. We know that they've been marching higher, and this week, again, first sign of strength in risk assets, commodity prices in agriculture, predominantly grains and soybeans, back to new highs. Wheat, corn, and so on continue to be very strong. And when we look at the DBA, which is an ETF of a basket of commodities, again, making new highs. So another commodity group continuing to show leadership. And when we look at the materials ETF, made up of companies that produce basic materials, came off the short-term moving average and very quickly resumed the uptrend. This was a natural pullback after having broken out. No sign of any change here. The metals and mining ETF, very similar, did have a pullback over the last week into the 50-day moving average, 50-week moving average, and it reversed higher and followed through today. Same thing for the MOO, which is the agribusiness, the corporations attached to agriculture. That would be the fertilizer companies, the equipment companies like John Deere, and the processors like Archer Daniel Midland. So no change in leadership in this basic materials group. Let's move on to some of the dividend pairs. Food and beverage, this is the PBJ ETF, held rising moving averages very nicely, certainly pulled back over the last couple of weeks, no technical damage. continues to hold, as do the utilities. Same picture, higher dividends, a little bit more predictable, holding above all the long-term moving averages. So for many, many months, basic materials and energy have led, dividend payers have led, and dividend growth has held. This is the FDL Dividend Leaders ETF. Look at how quickly we've bounced back towards high. In fact, when the market made its new low last week, this ETF held above the lows from earlier in the month, and we're almost back to new highs, making a new relative strength high yesterday. And if we put them together, one of the ETFs we've talked about over the last while is the GUNR, which is an ETF made up of upstream natural resource companies, producers, metals companies like BHP and Rio Tinto and Vale, the fertilizer companies like Nutrien and Archer Daniels, the energy companies like ExxonMobil and Chevron. It's a dividend paying ETF, yields 3.4%. It's grown the dividend 23% a year over the last 3 years. This is, I think, the sweet spot for what's working. Held up better during the decline and showing strength on the first sign of strength in markets. Let's keep moving. One of the things that we saw change this week is the pharma group. After a reasonably significant pullback, the PPH broke below the moving average and very quickly came back above the rising moving averages to turn higher. This ETF made a relative strength new high today. That's a new sign of strength. We added Merck in the equity portfolios. We already had some exposure to pharma, and we added PPH in our macro fund, really the only adds. And then let's go back to the groups that have been under pressure. We talked last week about how the QQQ had made a series of lower lows and broke this quadruple bottom, opening up a measurement lower. Well, of course, that's exactly what happened this past week. The QQQ got to a maximum decline of just over 30% and had bounced on Friday and followed through today. Again, great from a percentage point standpoint, but weak from a volume standpoint. This continues to be suspect, and we continue to be below all of these moving averages. I'm somewhat suspect because we saw flows into the tech ETFs last week, which really is not capitulatory action. That makes me somewhat suspect of that rally, but certainly we're getting there from a percentage point standpoint. If you look at where the NASDAQ has become oversold over time, it's tended to be in and around the 150-day moving average, which is exactly where we got to last week. We became as sold out as we've been in years from a stochastic standpoint, but we still really need to see a big volume day to support the fact that maybe we've made a low and we're still, even right at the end of the day, below the last 20-day average volumes. Other groups that continue to have difficulty, of course, non-profitable tech now down, well, as of last week, 79% from the highs. It's really quite remarkable. This is where the correction started in February of last year. The consumer discretionary sector down 34%. This is one that would be hurt by a recession or a change in spending habits. The communications services sector, which includes telecom and the social media companies like Facebook and so on, down 33% from the highs. No change there. Financial services, debt down 26% at the low point last week, still trading well below this breakdown point in the long-term moving averages. And this is what a decline looks like. From a point and figure perspective, and this is why we use them, we were making higher lows as of December, then lower low, lower low, lower high, lower low, lower high, lower low, lower high, lower low, lower high. We need to see that trend reversed before we want to go putting on significant positions in this group, despite the fact that the banks were up over 3% today. You can see there have been lots of false rallies since this correction began. So there continues to be haves and have-nots. And our job is to stay in the groups that are acting the way that they should be, given what we think we know, and stay away from those that may look fundamentally sound, may look inexpensive from a valuation perspective, but where price behavior does not support the view that we should be putting money to work. We said last week it's a step-by-step process. As of today, of 1,500 ETFs in the market, these are those that made relative strength new highs. US infrastructure, a dividend payer. JP Morgan, Alerian MLP, that's energy infrastructure. Cash cows, big cash generating companies with a solid dividend rate. Fidelity High Dividend, Tecrium Wheat Fund, agriculture. Mid-cap value, and S&P Pure Value. So value as a theme, which is something we've been talking about. Dividend, natural resources, oil and gas, basic materials. This is where the leadership continues to lie. So if we put up the statistics, company sectors with relative new highs versus those companies in the group with relative new lows as a percentage of issues, we continue to see concentration, utilities, energy staples, materials, and then industrials, but specifically around the defense group. Groups that are lagging: tech, financials, consumer discretionary, communications, and real estate. No real sign you can see from a trend perspective, and no improvement in breadth as of yet. A bifurcated market. So our job isn't to be everywhere. Our job is to focus in parts of the market that matter. I don't think our clients are looking for us to give them an index return. People can buy that for free by buying the spider. Our job is to watch for change. Well, we saw some improvement in pharma this week. That's something to keep an eye on. We saw some improvement in some international markets like Mexico and Japan. Those are groups that have had pretty strong relative performance over the last while. And in the absence of new leadership, be prepared to sit on your hands. So it's sort of a tactical approach. Here's where we sit. Energy continues to be by far our largest weight. And to be clear, this includes energy infrastructure, energy service companies, and energy producers. For the first time in a long time, we do have a bond position, partly because we think that the move in yields maybe has gotten a little bit ahead of itself, but primarily because we're in short-term bonds as a place to hold cash to be deployed as we see improvement in the breadth models. We do have a cash position, and we're not in a hurry to put it to work until we get some confirmation that this short-term bounce we've seen over the last few days is something that could stay. Consumer staples and utilities are providing us lots of stability and a nice dividend yield. The defense stocks are a small piece of the industrial sector, but the entirety of our industrial weight. And as you know, materials we took down, we added some back yesterday and today. So the position is a little bit larger than this, but it's a more volatile group. We're still being a little bit cautious. From an underweight perspective, very small position in communication services, healthcare, technology, financials, real estate, consumer discretionary. So the portfolio looks very little like the index. Globally, we've seen some relative improvement in Mexico. That's largely because there are basic materials companies within the Mexican market in energy, and Japan, which surprisingly continues to hold above the range it was in. And we can take this range all the way back to 1991. So this is a relatively new breakout of that trend. And that would fit with the fact that we've gone from a disinflationary environment to a reflationary environment. Japan probably the hardest hit by disinflation over the last few decades. From a macro perspective, in our macro fund, the weights are as you would expect: energy, materials, dividend, agricultural commodities, precious metals, Canada, which has been a relative outperformer, commodities from a metal perspective, a small position in healthcare, which we talked about, adding pharmaceutical, small position in utilities, and we've covered virtually all of the short positions that we had leading up to this past week. A couple of green shoots. Last week, we highlighted that while the market was falling, we were failing to make new highs in volatility. And that was something that was of note. If we fast forward to this week, volatility really has started to collapse. So that's one thing that tells us that maybe we are seeing a near-term low in the market. We're going to have to wait and see. From an earnings perspective, different than typical first quarter historical trends, we have seen some quite significant increases in earnings estimates coming out of first quarter earnings. this does not point to recession. So the fact that commodities are behaving well, given the fact that earnings estimates appear to be going higher, given the fact that first quarter earnings did come in ahead of expectation, I think that there's a very small chance, or much smaller than the market is pricing in, that we go into recession based on the fact that rates are going higher. But we're going to have to see. All I would say is that this pullback so far looks consistent with bull market corrections. And at this point, given the fact that our breadth readings became very oversold, we're watching closely for things that turn higher. I'll leave you with this. There's been a ton of talk about the market correcting for being in a recession. So here's all of the major S&P declines that occurred with a recession since 1950. And there's some big ones in here. But the reason I spend so much time on whether we're in a secular bull market or just a cyclical bull market is this. If you take out all of the declines that happened during secular bear markets, so let's go here to, this is 2007 through 9 during a secular bear market, down 56%. 2000 through 2002, that was after the end of the structural bull market, 1999. Structural bear market, 49% decline. If we go to the bear market from 1966 to 82, well, you had 1975, 1974, 44%, 74, 36%, 1970, structural bear market. If we go to structural bull markets, 1990 was a recession in a structural bull market. It was a 20% pullback. 1981-82 was in a structural bull market, 18.9% with a recession. 1959-60, the bull market went from 1951 to 1966, 14% with a recession. And here you go, 1957, which was during a structural bull market, 20.7%. Last one, 1953, again, during a structural bull market, 14%. So these range from sort of 14% to 20% during a structural bull market. We've seen a 20% decline now in the S&P. Then you look at the major declines that happened without a recession. Well, 2018 was during a structural bull market, 19.8%. 2015 during a structural bull market, 15.2%. 2011 was in the structural bear market, a little over 20%. 1998 during a structural bull market, 22%. The point is that in structural bull markets, which we spend time talking about every webcast we do, the pullbacks tend to max out around 20%. So that's not something to make a decision based on, but it's something to keep in mind. Our job is to understand the range of possibilities and they make the best decisions we can based on the tactical tools that we have. As it sits right now, we have some positions. You can see from a relative standpoint, they're behaving really, really well. The pools that we manage are anywhere from kind of down 1% to down 4% on the year against a market that's a lot worse off. And on a relative basis, we're having good days when the market bounces. So if it gets worse, we'll get more defensive. If individual positions that we own stop working, we will stop them out. And that's how we've managed declines in the past. But this week was a good news story because on the first sign of strength, our various leadership groups really came back nicely, and we'll see whether we follow through over the next few weeks. With that, Pamela, if there's any questions, certainly happy to answer them.
Hi, thanks so much, David. And bear with me, my internet seems to be a bit wonky today. So the first question we have is regarding energy, the energy environment. Eric wants to know, David, do you see Trudeau or Biden doing an about-face regarding energy policy, or will it be just a trickle-down effect for the next few years? What are your thoughts there, Dave?
Well, look, it's an important question. The net of it is that we need energy. And while we are moving towards a clean energy environment, solar had a nice bounce this week. Lithium had a pretty good bounce this week. The fact is, in the near term, we need oil and we need gas, especially when you've got situations where you can get a disruption out of Russia. So we know that during a structural bear market where oil went lower, actually the sector went lower by 70% between 2014 and 2020, there's underinvestment. And you can't just turn on oil and gas and get it to market in the drop of a hat. We have a lack of energy infrastructure and we've got a lack of production. Even if we can get production up, we don't have the infrastructure to deliver it. So I do think that there is a likely about face in the near term because politicians are politicians. And if the crowd gets loud enough, they take action. So I think that possibly could help us get some of these infrastructure issues addressed, but that's going to take time. And in the meantime, supply is going to be tight. Prices can go higher.
Thanks so much, David. The next question really comes down to, it's another question regarding energy. It seems to be our hottest topic today. So tourmaline versus CNQ. Tourmaline has seemingly been outperforming CNQ lately. What are your thoughts there? Why do you think CNQ is struggling here, David, or treading water?
Yeah, I'm not sure I would say it's struggling. Let's just take a look here. So, okay, so on a daily basis, CNQ made a new relative high versus the S&P yesterday. We're a little bit below where we were at the highs. If we take a longer term perspective, we broke out for above the 2014 highs several months ago, and marching on, we're in new high territory as of a month ago. If we take a look at Tourmaline, totally different company, more gassy. They've also taken out the 2014 highs, made a new relative high. It's got a 97 relative strength versus CNQ with a 98 relative strength. So it's a bit like splitting hairs. They're both performing exceedingly well. One, CNQ has, like 100 years of reserve life, and doesn't have a whole lot of capital spending to do in the near term. I think that these two companies make a pretty good package. Why wouldn't you want to own both?
Thanks, David. The next question is about uranium, sorry about that. David, could you please express your opinion on uranium and related stocks going forward, and if you have recommendations in this sector?
Yeah, look, uranium is quite interesting. This is the physical uranium ETF, the Sprott physical uranium ETF. If we look at a long-term perspective, we broke out, consolidated, we broke out, we pulled back into the long-term moving average. I own some of this personally. The URA is the ETF made up of uranium producers. It pulled back kind of into where we broke out. These tend to be held by more aggressive investors. They're a little bit more volatile. If you take a look at CCO, Cameco, I think it's structurally set up really, really well. We pulled back to the moving average. We dipped below it last week and closed back above the moving average. And today we closed higher than the high last week. That reverses 4 weeks of declines. And that would be a natural pullback. It's a big percentage point pullback. It's about a 30% pullback, but that's the way these uranium stocks act. From a small cap perspective, and Next Gen Energy looks kind of interesting, NXE. But if you want to own one name, I think Cameco is a pretty good one from a producer standpoint. I think they look quite constructive.
Thanks so much, David. The last question for today is regarding the assessment of sectors. So when we are looking at a sector, how would you and your investment team think about or look for signals with an eventual downturn in, for instance, natural resources or a possible upturn in technology? What is the investment team looking for with respect to a change in a sector?
Okay. So look, that's a multifaceted question.
Yes, very much so.
We talked
that could be
earlier.
like a whole topic on its own.
Yeah, but let's just do it quickly, right? Just to start here, we're looking for expanding breadth. So let's say there's 100 companies in the oil patch. We track every day for 41 different groups. What percent of stocks within that universe, giving each one a single vote, are in an uptrend or showing higher highs and higher lows? We define that by using those point and figure charts, which I put up from time to time. So for instance, of 41 sectors, there's 2 sectors that have recently turned back higher from a breadth perspective. The first one was oil, or oil and gas producers. So that means we have the green light to add new positions in energy. And you can see we had more energy this week than we did last week. So that's the first step. When we see breadth start to deteriorate, forget the index, because the index is dominated by the largest companies. The reason that we turned negative on tech before the FANG stocks broke down is if you looked at the tech indices that were dominated by the FANG stocks, they looked fine. But we know that under the surface, unprofitable tech was getting massacred. Now, it was a relatively small part of the index, so you wouldn't see it. But as you know, we talked about earlier, like the ARC ETF was down almost 80% in the last year. So breadth has been deteriorating in tech for a long time. So we watch a universe of stocks, say like energy or metals producers or consumer discretionary stocks, for signs of deterioration in breadth. And when we see the percent of stocks in uptrends start to deteriorate, it puts us in a heightened sense of awareness to say, okay, we now have deterioration in this group. We can't add any new positions. We have to tighten up the stop losses on our existing positions. If they continue on to perform well, that's great. But if they start to break down, we've got to have a very tight leash. So we spend a lot of time on these breadth models. Now, beyond that, if you want simple ways to look at things, I mean, let's just look at XME, for instance. Rising moving averages versus XLK. And so XME is metals producers. XLK, you know, the key moving averages have rolled over. And if we looked at the ARKK, that's on a 5-year basis. Let's look at it daily. Right? Moving averages all rolled over. So we are now skeptical, right? Breadth has weakened for a long time. It's not showing an improvement yet. And any rally up into these declining moving averages have to be somewhat suspect. So then, of course, we look at the leading securities in the group and how the leading stocks are doing. So there's a whole bunch of different things we look at, but primarily we use breadth as the determinant. And the reason that that's important is that everybody can stare at an index, and the index is made up of all the companies within the index, market cap weighted, and it can be very deceiving. QQQ held up until December or January because the biggest stocks held up until then, but under the surface, the smaller ones were not. That gave us a clue to be more cautious. Same with financials.
Thanks so much, David. And if anyone has any further questions on point and figure charting, you can reach out to us. We'd be happy to provide you with some literature and resources to help guide your way. David, that concludes the questions that we've received for this afternoon. As always, I'd like to thank you for your time and a great overview.
Oh, we lost you.
Yes.
All right. Well, listen, thanks everyone for joining us today. We'll continue to put one foot.
No, I'm here, Dave, but
Okay, all right. We'll continue to put one foot in front of the other as things change. Watch our Twitter feed. We do post stuff, and certainly tune in to these calls. And if you'd like to have a conversation about your portfolio or holdings, we'd be more than happy to talk to you. And if you're a client currently, thank you for being a client. We're working hard at navigating these markets. And if you'd like to have a personal conversation, please let us know. We'd love to jump on the phone or answer your questions. So thanks very much, Pam, and we'll see everybody next week.